On 28 November 2023, we lost an investing legend, Charlie Munger, an investing guru, Warren Buffett's best friend, and also a long-time business partner of his. Munger's passing not only made his admirers sad, but it also left a huge gap in the investing world.
We have some sad news to share. Charlie Munger, Berkshire Hathaway's vice chairman and Warren Buffett's longtime business partner and close friend, has died at the age of 99, just a little more than a month shy of his 100th birthday.
As we truly lost a wise mentor whose investing tactics were known all over the world. Today's video is to remember him. With his scandal, I pay my respects. And also today we'll be discussing some of his investment strategies and philosophies. Now, Charlie Munger was a true believer of value investing, and it was one of his core principles. He, along with Warren Buffett, tried to identify companies whose market price was way lower than its intrinsic value. Now, Munger's strategy went way beyond simple price analysis. He had to cover things like the operation strategies of companies, their financial health, their products, their vision, their mission, and also had to look at the future of the products they were selling. After all that analysis, he finally found the golden nuggets he was looking for and added them to his portfolios. In making investment decisions, Munger not only scrutinized the financial reports of the company, but he also looked into things like if the business model of the company was sustainable and its current market position in the industry. A great example of this is when in 2008, Charlie Munger invested in the Bank of America when its stock price was plummeting due to the market panic. The second strategy Charlie Munger believed in was the multidisciplinary thinking strategy. So this strategy was quite simple. Charlie Munger believed that every investor should know the basics of economics, psychology, sociology, and history so that he or she can analyze the market better and understand the emotions of the market. Now, Mr. Munger used these tactics of psychology to explain irrational market behavior, and it also helped him during the 2000 tech bubble where everyone was blindly investing in tech companies. The third thing Munger believed in was independent thinking. Now, Munger never believed that you should follow the crowd, because in the stock market, many people rely on tips and try to follow the news. But instead, he believed in doing your own research and understanding the companies yourself. He frequently reminded investors that following the crowd does not always lead to the best investment opportunities. He proved this when he invested in BYD, a Chinese battery and electric vehicle manufacturing company. Now, this was back in 2002, when most investors didn't even know about the existence of electric cars. Munger saw the potential of BYD way before anyone else could. That's because of a strong analysis, and also he believed in the products they were making. Another thing we can learn from Munger is his proficiency in risk management. Now, Munger believed that along with striving for large gains, we should also try our best to avoid large losses. His ability to judge risk made him cautious during the 90s, just before the tech bubble was going to burst. Munger's strategy emphasized on conservation and prudence so that he could avoid investing into companies that could potentially lead to huge losses. Munger's influence extends far beyond the specific investment strategies that he proposed. In fact, most of the legacy that he left behind was because of his investment philosophies itself. Now, in this complex world of investing, strategies can vary greatly, but having a solid foundation is the key to success. Now we are going to discuss some of the philosophies that the legendary investor followed himself. The first principle that Munger thoroughly followed was self-awareness. Now, he believed that every investor faces three choices. Now, that is investability, non-investability, and too complex to understand. So the investor should actually know his or her circle of competence. In simple words, invest in stuff you actually know about. Now, a great example of how Charlie Munger practiced this principle was that despite being friends with Bill Gates, he never really invested in Microsoft. That's because he did not fully understand how the company worked, so he stayed away from it. According to Charlie Munger, admitting ignorance is the first step to getting wisdom. He also explains how herd behavior is due to envy and jealousy, because when one person makes money, others try to copy his or her strategy and then they end up in trouble. The second principle that Munger believed in was cultivating contrarian thinking. What does that mean? Now, it basically means that you should always think about how to avoid failure instead of focusing on how to succeed. Now, when you start looking at the mistakes you could possibly make, you're less likely to make them. Warren Buffett, in many of his interviews, has said that he has never quite met someone like Charlie Munger, as not only his thoughts but even his character is quite strong. Contrarian thinking can help many investors because it's not only about being smart but also about avoiding as many mistakes as you can. Now, for example, in 2008, when the whole market was panicking, Charlie Munger was bold enough to take the cash assets from Berkshire and Hathaway and invest it into the US stock market. Now, that eventually gave unimaginable returns over the long term. And Warren Buffett has said that without the wisdom and judgment of Charlie Munger, Berkshire and Hathaway wouldn't be where it is today. The last principle we are going to talk about today is being cautious and prudent. Now, in the book Essays of Warren Buffett, Charlie Munger mentions a quote which goes like, "The man drowns in the water he knows best." Now, what does that mean? That basically means that when you're overconfident about the market, then you're more likely to fail and lose your money. Charlie once talked about his decision to buy Wells Fargo for the Berkshire Company. Now, this was basically partly because of market conditions and also partly because how much caution Wells Fargo showed with its investments and how great the company was at managing its assets. Munger knew that because of their caution and rational choices, this bank would be able to outperform other banks and also would be less likely to incur losses in the future. Finally, I want to end this video by telling two of my favorite quotes by Charlie Munger. And they go like, "Opportunity comes to the prepared minds, and big money is not made in the buying and selling, but in the waiting." So remember that, and happy investing. You can follow Bullsmart for more such informative videos.